rent to price ratio, you mentioned it, that luxury homes have a lower rent to price ratio, AKA your rent in comparison to what your mortgage is less favorable, right? Is that it?
Yes.
So rent to price ratio, what does that mean?
Yeah, rent to price ratio is an easy way to look at a property and say, is this in the ballpark of paying for itself every single month? Because if you've got $1 million home out there and it's renting for $3,000 a month, there's no way that when you factor in the cost of the mortgage plus the cost of the insurance and the property taxes and everything else that goes along with owning a rental property, there's no way that in each month you're going to have enough to pay for the expenses coming from the rents. And so you can just look at what the rent is and look at what the market value of your home is and say, well, is this even somewhat close? You know, to put it in perspective, you know, the rent to price ratio in workforce housing neighborhoods might be about 0.6% or somewhere around there. So, you know, if you're in luxury houses, I'm just off the top of my head, it's a lot lower than that, right? So if you're in 0.6 to 0.7%, you're in workforce housing. That's an easy way for you to say, okay, well, especially with JWB neighborhoods, that's where I know that this thing can pay for itself and reduce my risk so that this is not something that I have to go negative every single month. And when you get to luxury housing, that's the first decision that you're faced with is, well, is it worth it for me to make this investment knowing that I'm going to spend thousands each month just to hold on each and every single month, which I don't like that. Do you like that?
No, I'm not crazy about that.
No.
So rent to price ratios essentially meaning how much of your mortgage is your rent likely to cover. Higher in workforce housing, which means that it's a higher likelihood that your mortgage plus then some is covered and you're making positive cash flow. Lower in luxury homes.
Exactly.
There's another difference in these two asset classes that I think became really apparent to me during COVID, and it's like the volatility of the demand. You want to talk about that?
Yes, absolutely. So, you know, when you're supporting these types of individuals who are essential workers, there is inherent risk mitigation just in the people that you're serving, right? If you think about our job as an investor is to create a great living experience for the resident, then you're serving that population of essential workers. They're essential workers. They're called essential workers because we need them in all types of weather. And we've seen that from COVID. We've seen that in many different things that we've endured as a country over the last 10 years, right? We love our essential workers, you know, and that's not to say that we don't love others, but what I can say is that, you know, if you're a high income earner, your job may be more at risk. If you are one who may be living in a luxury neighborhood, you might have a job that might not be quote unquote essential to the operations of our community. And inherently, there's more risk associated with that type of a job than nurses, teachers, firefighters, police officers. And so what this does is this creates a very stable job base. And those folks need a great place to live. And so your assets are more and more in demand, and there's less risk associated with rents going down or vacancies happening simply because of who we're serving.
That's interesting, man. I hadn't thought about it from the job perspective. I was thinking about something else, which I'll talk about right now, but it makes me think of this idea that we just went through a white collar recession.
Yeah,
right?
exactly.
Like
we did a show on that.
Yeah, we just did a show on that. And like the fact that like the tech sector is kind of like the canary in the mine. They all, you know, there was a ton of layoffs in the tech sector, but our economy is still crushing it.
Yeah.
You know, like I'm not poking fun at the tech sector, right? But like the economy is doing really, really well. Unemployment is really low. And yet I still hear about layoffs and despair inside the tech sector because at the end of the day, that is the part of the economy that likes to get like overinflated and underinflated and overpriced and whatnot.
Right. It's more opportunistic.
Yeah. So likely to lose the job. I was thinking more along the lines of the disposable income side of it that we've talked about, right? This idea that if I am, like you said, if I am renting a luxury home on the beach or even just luxury apartments close to the beach, like what I was doing over the last 5 years, this whole time I have had the option to move closer to the urban core, buy a home for much cheaper and have a lower mortgage payment than my actual rent is. But I chose to rent where I want to live and invest in these in these neighborhoods, right? So that was a choice for me.
Right.
Whereas folks that rent in workforce housing, it's not so much a choice. It is their best option,
It is
right?
their
Like,
best option.
yeah,
Yes.
it is their best option. And that is what they're hoping to do. And even more, the folks that are, if I all of a sudden hit really hard economic times and I couldn't continue to live, like, and I was like really looking at my expenses and I lost my job and whatnot, then I would have gone from luxury apartment back to workforce housing to lower my monthly expenses. And therefore, it's like this like insulated asset class where the demand for it comes from the folks that always demand it. And in hard times, it pulls demand from another sector that, insulates it from like the fluctuations we're talking about.
It's risk mitigation. Any way you look at it, workforce housing is risk mitigation. The weird thing is that through a different lens, people look at owning rental properties and they think workforce housing may be more risky than luxury houses. This is where our not your average perspective comes into play, because I can tell you that luxury houses are more risky, because when we first started 18 years ago, I didn't know all of this stuff. And I tried to rent out luxury houses. And I know what the pain of spending a few $1,000s a month times 20, 30, 40, however many we had at that point. It was not fun. It was speculative. So that switch of what real risk is and how to mitigate it is important. And I did want to make one other point too. I just needed to share these numbers again, because I do feel like there is a negative stigma around when we say workforce housing. And it's not accurate, right? When we're talking about workforce housing, we're talking about homes and folks that are living in these neighborhoods that are making median income or sometimes up to 120% of median income, right? So when we say things like this is their best option, that is not, I don't want that to have the negative stigma, like this is not a good option, it just happens to be their best option, right? As a housing provider, no matter where you are, people are always going to make the decision for it to be their best option, right? But for some reason, there's this negative stigma, right? We're not talking about low income here. There is a very big difference between low income and workforce housing. And there's a reason we don't go to low income as well. It's because you start to see more risk from maintenance costs, vacancy costs, crime, other things of that nature. So just want us all to
when you said that figure of like up to 90 grand a year, I was like, oh, okay. This is a mid-level manager. This is, like different kinds of, it's a different, I think the stigma that you're talking about is that low-income housing stigma that's like elevated crime, maybe less reliable payments from folks because they're living paycheck to paycheck more so. This sector seems to be what I like to call the Goldilocks zone, right? Like it's just kind of like, it's not too hot, it's not too cold, it's just right.
It's just right.
Right, like the porridge. Anything else from a conceptual level before we jump into the data, GC?
No, I think we're good.